Let me tell you something that nobody in the financial world actually wants to admit out loud. Most of the advice you're getting about money, the stuff your bank sends you, the stuff your HR department hands out, the stuff those glossy adverts push at you during the football, is designed to make other people wealthy, not you, them. I've spent over a decade in the trenches of investing. I've made mistakes that cost me sleep. I've made decisions that changed my life. And I've watched hundreds of people either build genuine, lasting wealth or quietly hand their money to institutions that couldn't care less about their future. So if you've got $50,000 sitting in a bank account right now, or you're working toward that number, I want to have an honest conversation with you. Not a polished sales pitch, a real one. Let me walk you through exactly what I would do if I were starting again today with 50 grand. Before we talk about what to do, let's talk about what not to do. Because there is an enormous amount of noise out there, and most of it is either wrong, misleading, or just plain dangerous if you're working with real money. Cryptocurrency, I'll say it plainly. I'm not going to stand here and pretend cryptocurrency doesn't exist, and I'm not going to pretend I've never touched it either. But here's the truth. If someone cannot sit across from you at a kitchen table and explain, in plain, clear language that a teenager could understand, exactly how a particular digital asset creates tangible, real-world value over the next 30 to 50 years, then it is not an investment. It is speculation. And speculation with money you've worked hard for is a gamble, full stop. Some people have made enormous returns. Some people have lost everything. The difference between them and a casino is smaller than the internet wants you to believe. If you've got crypto, that's your business. But we are not counting it as a foundational investment strategy here. Precious metals, gold, silver, platinum. People love these in uncertain times. And look, I understand the psychological appeal. They're physical, they're ancient, they feel safe. But here's the reality. Gold doesn't generate income. It doesn't pay a dividend. It doesn't rent to a tenant or grow earnings year over year. It just sits there. Its value is driven almost entirely by sentiment and fear. Over very long time horizons, gold has returned roughly 1 to 2% per year in real terms. You can do far better. Picking individual stocks. I know that sounds controversial, but hear me out. Over 90% of professional fund managers, people who do nothing else but analyze companies, read balance sheets, fly to shareholder meetings, and live and breathe the markets, fail to consistently beat a basic market index over 10 plus years. 9 in 10 professionals. So the idea that you, watching this video with a full-time job and a life to live, are going to consistently identify winning companies before the market does, that's not confidence. That's overconfidence. And overconfidence is one of the most expensive habits a new investor can have. So we've cleared the noise. Now let's build something real. Here's something critically important that most people get completely wrong. Pensions and ISAs are not investments. Say that again. Pensions and ISAs are not investments. They are tax wrappers, containers that hold your investments and determine how those investments are taxed. The actual investment decisions happen inside them. Getting this distinction right changes everything. Now, I want to be careful here because this is my personal view and not financial advice, but I'll say it anyway. I think the traditional workplace pension model, where your money disappears into a giant managed fund, you have virtually no say in where it's invested, and then decades later you collect whatever's left after fees, is one of the worst financial deals available to ordinary working people. The average net annual return after charges on many traditional pension arrangements is somewhere around 2%. Over the same period, even a basic global stock market index has historically delivered 6 to 8% per year. The maths here are not complicated. The question is whether you're willing to take control. That's where SIPs come in. A SIPP, a self-invested personal pension, gives you the ability to decide exactly where your pension money is invested. As a business owner, you can currently contribute up to £60,000 per year, though the rules vary for employees, so always check with your accountant. The real power here is twofold. First, contributions go in pre-tax, meaning every pound you put in has never been touched by income tax. If you're a higher rate taxpayer, that's an immediate 40% advantage before a single investment decision is made. Second, because you control where it's invested, you can direct it toward assets that have a genuine track record. There's also something called a SSAS, a small self-administered scheme, which takes this a step further, allowing for even greater investment flexibility and the ability to pool pension funds with others, such as business partners or family members. It comes with more administrative responsibility, but for experienced investors who want maximum control, it can be a powerful vehicle. For most people starting out, though, a SIPP is absolutely the right first step. Now, let's talk about ISAs. The individual savings account lets you invest up to £20,000 per year, and everything that happens inside that ISA, every bit of growth, every dividend, is completely tax-free. Not tax-deferred, tax-free. Within that £20,000 allowance, the first $4,000 should go straight into a lifetime ISA if you meet the age requirements. Why? Because the government adds a 25% bonus on top of whatever you put in. £4,000 becomes $5,000, risk-free on day one. There is genuinely no other mechanism available to ordinary investors that gives you an instant, guaranteed 25% return. Use it every single year that you qualify. So, you've got your SIPP. You've got your stocks and shares ISA. Now, what do you actually buy inside them? If you don't have deep expertise in analyzing individual companies, and the overwhelming majority of people don't, and that's nothing to be ashamed of, then the answer is a low-cost global index fund. A global index fund simply tracks the performance of hundreds or thousands of companies across the world. When you invest in one, you are essentially betting that the global economy will continue to grow over time. You're betting that human ingenuity, commerce, and innovation will keep producing value. That is, historically speaking, one of the safest bets you can make. Over any rolling 10-year period in modern market history, a globally diversified index fund has produced positive returns, not every year, but over time, reliably. The key word is low cost. Some funds charge you 1.5% or more in annual fees. That might sound trivial, but over 30 years, that difference in fees can cost you tens or even hundreds of thousands of pounds in lost compounding. Look for index funds with total expense ratios below 0.2%. They exist, and they're accessible to everyone. So the structure looks like this. $4,000 into your lifetime ISA for the government bonus, the remaining $16,000 topping up your stocks and shares ISA, and then your pension contributions on top of that, all directed into a low-cost global index fund. Set it up, automate it, stop watching the markets every day, and let time and compound growth do what they do. This is not exciting. It is not a story you tell at a dinner party, but it works with a consistency that almost no other strategy can match. Now, let's talk about property. Here's what I want you to understand before we dive into the numbers. Property is not for everyone. It is not the only path. And anyone who tells you it's completely passive has either never owned a rental property or is trying to sell you something. But for building long-term generational wealth, for people who want to create something that outlasts them, there is a compelling, evidence-backed case that is very hard to argue with. Let's keep this simple. Forget HMOs. Forget serviced accommodation. Forget rent-to-rent, lease options, and every other creative strategy you've seen promoted online. Those strategies can work, but they require time, expertise, active management, and a tolerance for complexity that most people with full-time lives simply don't have. If you're not going to be a full-time property investor, you don't want those strategies. You want buy-to-let. Boring, vanilla, straightforward buy-to-let. Here's what the numbers look like with £50,000. You are not buying a property outright. You are using your £50,000 as a deposit, covering stamp duty, legal fees, and potentially a light refurb. On a property purchased at around £130,000, a 75% loan-to-value buy-to-let mortgage puts you in a strong position. You own it. You control it. The bank has a charge on it, but you make the decisions. At a 7% gross rental yield, which is achievable in many parts of the UK if you buy in the right locations, your annual gross rent sits at around £9,100. Once you've accounted for management fees, maintenance, void periods, insurance, and the cost of your mortgage, your realistic net income is going to be somewhere in the region of £2,000 to £2,500 per year after corporation tax if you're holding inside a limited company. At 19% corporation tax, you're keeping around £2,000. Now compare that against putting the same £50,000 into a global index fund at a 7% average annual return. That generates roughly £3,500 per year in tax-free growth. On pure income terms, the ISA wins, and that's a genuinely important point to acknowledge. But here's where property changes the equation entirely. Capital growth. The average annual property price growth in the UK over the last century sits at around 7 to 8% per year. Not every year, prices fall, markets correct, but the long-term trend is unambiguous. For our purposes, let's use a conservative 5%. 5% of a £130,000 property is £6,500 of capital growth in year one. And here's the critical insight. You didn't invest £130,000. You invested £50,000. The bank funded the rest, so that £6,500 of growth is happening on an asset that cost you £50,000. Your actual return on equity is dramatically higher than 5%. Add the net rental income of £2,000 to the capital growth of £6,500. And you're looking at roughly £8,500 of total annual return on your £50,000 investment, against the ISA's $3,500. Both are good outcomes, but the property wins on total return. And then, 5 years down the line, you remortgage at the new higher value. You pull equity out, tax-free because it's released through debt, not income, and you use that equity as the deposit on your next property. This is how a portfolio is built, not through extraordinary luck or secret knowledge, through patience, leverage, and the systematic reinvestment of equity. So which should you actually do? Here is the honest answer. It depends on what you want your money to do. If you want the simplest possible approach, the one that requires the least involvement, the least decision-making, and the least stress, then maximize your pension contributions into a low-cost index fund via a SIPP. Fill your ISA allowance starting with the lifetime ISA and automate everything. You will almost certainly build significant wealth over 20 to 30 years without needing to think about it much at all. If you want to build something tangible, an asset base that you can touch, leverage, grow, and eventually pass on, if you want to accelerate your timeline and create something with a life beyond your pension age, then boring, vanilla buy-to-let property, bought sensibly in strong rental markets, is your vehicle. I do all three personally. Every year I max out my pension. Every year I max out my ISA, and every year I buy as many straightforward buy-to-let properties as I can, because I understand that diversification is not just about managing risk. It is about being positioned for multiple kinds of growth simultaneously. But if I absolutely had to choose just one, it would be property. Not because the numbers are always better on paper, but because property gives you something that no ISA or pension fund ever can. Leverage. The ability to control a significantly larger asset than you can afford outright, and to capture the growth on that entire asset. That leverage, applied carefully and patiently over time, is the reason so many of the genuinely wealthy built their fortunes through real estate. The Sunday Times Rich List has told us this story for decades. The majority of people on it built their wealth through property or hold their wealth in property. That is not a coincidence. That is a pattern. And patterns in investing matter. The biggest mistake I see new investors make is not choosing the wrong strategy. It's waiting. Waiting until they feel ready. Waiting until the market looks better. Waiting until they understand everything perfectly. That moment never comes. The people who build wealth are not the ones who waited until they had perfect knowledge. They are the ones who started with imperfect knowledge and kept learning as they went. £50,000 is a meaningful amount of money. It deserves a thoughtful, considered strategy. It also deserves action. The world is not going to do less well over the next 30 years than it has done over the last 30. People are going to keep paying rent. Companies are going to keep generating value. The mechanisms for building wealth are in place and available to you right now. Your job is simply to start. Automate the ISA. Set up the SIPP. And if the property route calls to you, if the idea of building a real asset base, of buying something that will outlast you, genuinely excites you, then find the right advice, build the right team around you, and take that first step. This is your moment. Don't let noise, indecision, or fear of imperfection be the reason you look back in 10 years and wish you'd started today.